Hey guys, so today I just wanted to talk about the differences between a retail location and a wholesale location, that's what we call them in the industry, or a broker versus someone who works directly for a lending company. So what I'll do is I'll share my screen here and pull up my little writing sketch pad here. And I'm just testing out the sketch pad, so forgive me for my handwriting and my drawings and things like that. It's kind of hard looking in one place and drawing in another without any feedback on it. So here we go. So in the world of mortgages, we have two sides. We have the broker or the wholesale side, and then over here we have the retail side. Retail. We have the retail side. Okay. And on the broker and wholesale side, the main difference, the obvious apparent difference on the broker side is they can shop for your loan. On a retail side, they get what they get. They can't shop for your loan. And what I mean by this is in a brokerage, okay, such as I'm a broker, okay, is they have the company, the brokerage company, sets up lots of different agreements with different lending companies. We have lots of companies in Utah, Caliber, who else? Provident, Parkside, just some of the ones we're set up with. There's a whole bunch of companies that are licensed in Utah to do lending. Caliber, Provident, Parkside. Let's think of another one. Stearns. Okay. And whenever the loan officer is meeting with clients that come into their office, here, then that loan officer can go through and say, okay, who's going to be the best lender for your scenario? Okay. Now, on the retail side, their company over here, their corporate windows, right? And there's a loan officer that works in here, and let's call them, let's use the example of US Bank. Okay, US Bank actually does have a brokerage side. We won't get too complicated here, but we'll just say if you go into US Bank or if you go into a credit union, then all that they can offer is that one type of loan at a time. All they can do is offer that one type of loan that is authorized by that credit union or US Bank to do. Okay. Now, the other thing that happens is they are beholden to all of the rules, okay, for lending, and we call those overlays. There's two main bodies that regulate mortgage industry. Well, there's lots, but everyone knows about Fannie Mae. Everyone's heard about Freddie Mac. Not a lot of people have heard of Ginnie Mae. Ginnie Mae. And these are the companies that set up the rules for lending, okay, basically in the whole entire industry. So all of our companies here and our company over here, they have to follow these rules, okay? But these companies, and every company actually, gets to make additional rules on top of Fannie, Freddie, and Ginnie rules, okay? And those are called overlays. Those are called overlays. So each of these companies also have overlays, okay? But here's where it differs, okay? If I have a couple come into here, okay, and let's say they have something happen to their loan where this loan officer says, nope, nope, I cannot get you qualified. Okay. Well, and the reason could be one of their overlays, one of their rules. Okay. So now what does this company have to do? What does this couple have to do? They have to get in their car and they have to drive to another company, right? To say, okay, was it just a rule that this company had, or was it a no based upon one of their rules? Okay. A lot of times these companies won't disclose and really won't give these people the benefit of a doubt saying, oh well, if I can't do it, then no one can do it. Sometimes those retail companies will do that. But a lot of times, what I've seen is these couples, these people who go in and get an offer for a loan. If they get told no, rather than going around and shopping, they'll just take that as kind of a global no, and instead of going around and seeing if there's any other options, they'll just drive home, right? And they'll say, "Woe is me, boo! We can't get it. We can't get approved for a loan." Okay? And but let's take that same couple and bring them over here to the broker side, okay? And say this loan officer takes their scenario and they say, "Oh, hey, Caliber, will you be able to do this loan?" And Caliber says, "Nope, we can't do it." Well, that loan officer doesn't have to go and tell that couple, "Oh, sorry, you can't do anything," unless it is due to one of the governing body's rules and requirements for lending. Then everyone will say no. But lots of times they'll find out that the reason for this no over here was due to one of these overlays, one of the company's rules and overlays, where if you get a no over here, they can just say, "Okay, we're going to take that scenario and we're going to give it to the next lender, and we're going to the next lender, we're going to give it to the next lender." Okay? And by that way, you have a more likely get more yeses. Yes, yeses. Apostrophe. I know there's not an apostrophe, but there's our yeses. Okay, so you get a lot more happy people over here on the broker side because there's not as many rules and overlays that you're beholden to. Well, there's actually a lot more, but you can shop around and you can find the one that is going to allow that file to go through rather than only getting the no over here. Okay, so the other thing I wanted to talk about is the other main difference. Maybe I can just start to erase stuff, but maybe I can just write it here. So the retail loan place. The other main differentiating factor is retail has a lot of costs associated with it. Okay, what I mean by that is the company that's lending the money, let's call them U.S. Bank, they have all of the charges for running the company. Okay, so they have all this overhead. And whenever they give a loan, they're like, "Okay, well, if we're going to give a loan, so here's a bar graph of their loan, and this is the total cost of the loan." They're going to say, "Well, we need to pay for our loan officer's salaries. We need to pay for their benefits. We need to pay for the operation of the company, the company cost, keeping the lights on, and other things we need. We need to pay for all of our staff." And then this amount here represents their profit. Okay? And so the total cost of the loan is pretty high. It's pretty high over here. We're on the broker side. If you have this brokerage and they are giving a loan to Caliber, Caliber is not going to tell the brokerage, "Oh, well, we need to pay for our building, we need to pay for this, we need to pay for that, we need to pay for this." They don't have all these extra costs associated with that mortgage loan. Okay, so what you're going to find is a lot of times is that the profit requirements for a brokered loan is a lot smaller. The profit requirements will be about the same, but the total cost will only be that much, right? Instead of that whole entire amount. So on the wholesale side of things, they are a lot lower rates because rates equal profit in the mortgage world. Rates higher. So those are the main things I wanted to get across today, is that with a broker, you get to shop around for your loan. You get a lot more yeses because you can go to a company that doesn't have as many overlays as over here on the retail side. And you're going to end up with lower rates, right? And everyone wants the lowest rate possible for their scenario. No one wants to pay more than what they need to. So that's why in my career, I have always opted to be with a broker. I've always opted to be with brokers so that I can shop around for my clients and make sure that I give them the best scenario for them without having to be beholden to all the corporate rules and laws and things like that, and be able to serve my people better. So hopefully you've enjoyed this and learned something from this. I'll try to keep them short every time I do these, and we'll just create more in the future, kind of exposing the secrets of the mortgage industry, and so it's not as veiled and mysterious as I think that sometimes it can be. So thanks for watching, and we'll talk to you later.